Hi, everyone, and welcome to the Macro and Global Liquidity Analysis Gold, Silver and Bitcoin monthly update for November 2025, proudly brought to you by AinslieWealth.com, where you can find all the latest research that we are presenting here today. Look, it has been a monster of a month, and there's still a lot to go. This is going to be our last one for the year where we get together and talk about this stuff, so there's going to be so much to discuss. We've got the best people I can think of to discuss this with today, Joe and Paul. How are you going? What a month.
Good, mate.
The best people, the best, poor Drew.
Well, no, Drew as well, but he would be caught in his land cycles here. So I think we've got more pressing issues than 18.6 years to deal with at the moment, I think. Look, there's so much to get into that we really want to go through with our framework. We've been having so much debate and discussion internally. I want to dig into all that. Before we begin, though, I'll sort of throw to you, Paul. We've talked throughout the year about what we've been doing with the Ainslie Group. Obviously, the bullion business has been, there's been lots happening there. It's been a hell of a year for bullion. The crypto business has been strong as well because there's been so much happening in the crypto space. But this year for us was really about the fund. We've mentioned this a few times, but I'll just get you to recap for people where we are on that journey, because it's an interesting one, and probably now is highlighting for people and for highlighting for us why it's so important to be thinking about these issues and why we're approaching the fund in this way.
Yeah, 100%. I mean, just recap that the fund is really just a secure exposure to Bitcoin with active management of drawdowns through metals. Where obviously, as we're recording in the middle of one of those drawdowns, we'll draw the distinction, no doubt, through this talk of this not being the drawdown of this cycle. So it's I guess timely to remind people that having someone actively managing your Bitcoin can remove some of the emotion of that journey, and obviously, gold's demonstrating again its ability to hold strong in many environments.
And when you just said there, having a team really is how we approach this. It's not just one person thinking about how this is going, and this is really what we're going to be discussing today is some of the insights that this team has had. But do you want to just give a quick overview of the process again for people who might not be familiar?
Yeah, absolutely. So this fund runs a weekly investment committee meeting. And that committee's myself, Josh, the fund manager, Paul Engeman, and Jamie Coots, who a lot of viewers will know from Real Vision. And then, of course, you and Joe form that economic advisory panel that comes in, and a lot of the debate you two are having, which is robust, is still continued into that investment committee, where so everyone in the room is forms a very informed position off a very solid framework, and then the usual behind the scenes with all the compliance and finance and everything as well. But it's a great collection of different minds looking at some structured data.
Joe, I think Paul was giving us a bit of a hard time there. I think we're in more agreement than we usually are at the moment. So we'll see how we go today and see how this discussion unfolds. But just before we dig into anything else, a reminder that everything we say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. So, look, we'll stick with the process we've been following all year, that idea that we'll look at the liquidity cycle, we'll look at the macro cycle, we'll look at the Bitcoin cycle, see how it all fits together, look at gold and silver, provide our trading plan. But probably the bulk of the conversation that we've been having this year, not this year, this last month, is around where we are in the cycles, because we've had this little bit of complexity, this little bit of contradiction potentially between what's going on in the liquidity cycle and what's going on in the macro cycle. Joe, I'm going to start with you on this. We have put in and said that the global liquidity cycle is now decreasing. Now, this is a big call. We'll dig into this in more detail in a second, but this is something I think that people will have a lot of different perspectives on. There's a lot of challenge. There's a lot of debate, as we've been having. Talk to us through that decreasing there and what that actually means?
Yeah, so as we go through these charts today, it will come across as if global liquidity nominally is still increasing, and that's absolutely correct. It is still increasing. However, as we've pointed out on multiple episodes over the last 6-12 months, it's about the rate of change, and markets are always forward-looking. So if that rate of change is slowing, then you don't have the juice behind the growth and liquidity to keep asset prices up. So our concern over the last 6 to 8 weeks has been not necessarily the Treasury QE part of the equation, but it's been more the bank reserves part of the equation, which is fundamentally the base of the monetary system and plumbing in the US. We're looking very US centric when we're talking about these things at the moment. So yeah, we'll talk about that and how our outlook for global liquidity in terms of that base layer of reserves has been not going gangbusters, and we don't really see how it goes gangbusters over the next 3 to 6 months unless something unfolds or a crisis or something happens.
And this is such an important point, and it's so different from a lot of other analysis that's out there that we really do need to dig into that, because I know some people watching this will have very specific questions that hopefully we'll be able to answer. Paul, I'll sort of flip over to you to talk about the macro cycle in a second, because no one can deny we've been in a bit of a pullback in Bitcoin. We made that decision that we were sort of going to sit through this particular pullback. Whether or not that ends up being the right decision, we'll be able to judge as we go through this. But I want to just ask you about the macro cycle part of this from our big picture overview here. We've had this chop. You've talked to us about this month after month, saying COVID, that whole previous cycle that we went through was extraordinary. Is that what we're continuing to see play out here when we get this sort of mid-cycle, early cycle, back and forward chop, no real clarity, when we're also suggesting, as Joe was alluding to, that potentially liquidity cycle might be peaking? The other side of this macro side is confusing.
Yeah, it is. It's here we are, in early cycle again. But it's instructive. So as you said, we made the call to ride out this pullback in crypto, and everyone newcomers to crypto have to remember 30% pullbacks around this time in the cycle are not unusual, and we hit 35, so a little bit more than usual, but certainly not well out of the bounds. And it's against this backdrop of a very tepid recovery out of the previous cycle. And the previous cycle was, it keeps using the same word. It was extraordinary, right? We had the confluence of unprecedented monetary stimulus, some of which went, through stimmy checks and that sort of stuff straight into the economy. Some went to assets, and then we've had, inflation that wasn't just because of all the monetary debasement, it was also supply side. So we just had the perfect storm, and we're coming out of that with, central banks full of with their balance sheets full, trying to unwind those. Trump with the tariffs, the unknown effects of AI, and whether businesses are holding back because of how AI is going to play out. So there's been a number of factors that will affect the business cycle, so to speak. But against that, we are seeing PMIs both in the US through the ISM that we track, we'll go through later, but also globally through S&P's PMIs that are above 50 and looking constructive. Earnings are starting to rise. So it does look like it's heading up and to the right, but we're on high alert, absolutely. Because of that, we're below that 50 line in terms of the index.
And everyone will want to sort of talk about the Bitcoin price, because you look at that and go, well, clearly it's had a pullback. No one's denying that. But we've said the whole time the beauty of our framework was the pullbacks that we skipped, right? Like it's the ones that we chose to ignore, because you look at those, well, there's sort of 3 examples in the lead up to this that were pullbacks that we just said, no, we're not there. At this stage, we're going, well, we are approaching the end of that liquidity cycle. So this pullback is probably more significant, but you still don't sell at the lows here, Joe. Like I think the capitulation that goes on is dangerous for people's wealth.
Yeah, and I think like exactly to your point, there's this drawdown that we've seen over the last 4-6 weeks has been larger than what we would have generally anticipated based on where we thought global liquidity was we do acknowledge that it is slow. The rate of change is slowing, and if you look at market positioning, you're exactly right. It's far too oversold in our opinion. That doesn't mean that it doesn't go down, but based on balance of probabilities, you'd expect to bounce, and that's what we're looking for here. And then we'll reassess where we think we are in that liquidity part before potentially putting in some form of a sell signal.
And we'll dig more into how far away that is from where we estimate a little bit later, because there's certainly a divergence there, and they've been very successful when we've looked at them historically to see that you do get a snapback generally in the Bitcoin price. But we'll look at that against the backdrop of the big headline for us this month, the new dot, and we've called it the AI boom. We got AI to help us on coming up with that title. It took a little while. It churned through all this data and said just two words at the end, AI boom. So I went, okay, well, that's what the AI wants to call it. So we'll call it that. Paul, this is interesting. We had a discussion around this, the idea that the COVID extreme being so high, it maybe shouldn't be a surprise to see the AI boom, or whatever we want to call this next bubble, this next boom cycle, being a lot lower. That kind of aligns with what you were just saying before, doesn't it?
Yeah, I think so. And again, just in that macro political and economic environment as well. This is not clean air. So I don't think we should be too surprised. There's endless people talking AI bubble, not boom. But that's one particular part of the market. So no, I don't think it's a huge surprise, just given the extent of that previous cycle.
And I think it's fair to call it a boom. Like it's like, whilst there is obviously a lot of I suppose exuberance in the AI part of the market, it's I wouldn't go ahead and say it's actually a bubble yet. I think boom is the exact correct term, the way that's been labelled.
And that is probably something we won't know until hindsight, because you would need to see the bust. But so far, we have certainly not seen the play out similar to the analogy everyone always makes with the .com bubble.
Absolutely. I was looking at some figures this morning, and look, in the 3 or 4 years leading up to the .com bubble, the Nasdaq was up 800%, right? So over the last four years, I think it is, the Nasdaq's up 100%. So it's literally up 1/8 over the same period of time. So to call it a bubble that draws parallels to the .com bubble is probably a little far-fetched in my opinion.
Yeah, and in a handful of shares too, as opposed to much broader .com. So
absolutely,
it's very different. Yep.
And again, reiterates this idea that the liquidity just wasn't at that same level that you saw back then, and we can see that clearly on this chart. And if people go and are sort of on the AinslieResearch.com site, where you can read this report, you can have a bit of a more detailed look in there, because we do actually provide sort of some background. Now, what informed this to some degree really was this separation of what's happening at the moment in terms of advanced economies versus necessarily the index as a whole. So I'll put this chart up here just to show that you can clearly see the advanced economies, which really just excludes China, painting a fairly clear picture that a peak could be into this cycle. When you look at the next chart, which is the index itself, including China, it's not quite as clear. I might hand this one. Well, who wants to tackle this one? Because that is something important to understand, I think. Joe, do you maybe want to sort of explore that?
Yeah, and that comes back to what we were saying around Bitcoin not selling the bottom, right? Because our base case is that we still get an uptick based on this chart in liquidity. Like we have had that sharp drawdown, but it also doesn't mean that you panic sell at 80 or 81,000. You wait for the bounce in assets, you reassess on where we think we are in liquidity, and then you make a decision from there.
And we've spoken often about whether this is more like the 14, 15, 16 period, and you can see that to the left of this chart, where there wasn't, I talked about that perfect storm that was the perfect cycle that was COVID, because that was just so engineered. And when you look back at the 14-15 cycle, that was all around QE2, QE3, QE4. Like it was interventions, and we're arguably off a huge event in the GFC. So we're arguably in similar space. And what it also clearly demonstrates is this can chop. They're big chops, but it can chop for a while, and it doesn't necessarily at all mean that peak in December 24 was the peak of the cycle at all.
And I think also, like a lot of our debate has been around, well, where does the next wave of liquidity come from? And generally speaking, like if you look back to that period Paul's talking about, you got the QE 2, 3, and 4, and they're all announced, and that's clear signal from policymakers that, yes, we are going to be injecting liquidity into the market. Whereas at the moment, we don't really have a clear message from policymakers where the liquidity is coming from. There's some ideas going around, but we're not necessarily seeing any of them as super liquidity positive. And we're not talking about rate cuts either. We're talking about balance sheet stuff. We're talking about TGA being drawn down and potentially a large amount of bill issuance going forward. So, yeah.
Well, let's dig into that a little bit, Paul. When we talk about some of the metrics, what a lot of people are commenting on is the expectation that there's going to be all of this stimulus coming from the Treasury, right? Like that you're going to have all this spending going into the economy. You make the point quite regularly that when you look at this chart, for example, the bulk of the chart is made up from things like the dollar, volatility in the bond market. We'll look at those specifically, but the mix that makes up the bulk of this chart isn't necessarily going to receive the same level of juice that you got previously from this Treasury stimulus. It's not the same thing.
No, it's not, because we talked about QE2, QE3. That was all QE. Like that was pure juice from the Fed into bank reserves that inflated assets. Whereas we have a very clear message from the current administration is that they don't want to do that again. They want Treasury QE, so to speak, rather than central bank QE, which is very, very different. So they're trying to juice Main Street, not Wall Street, and by definition that'll be slower. And by definition that puts pressure on bank reserves because the central bank's the only one that can add the bank reserves. So it's where. And Joey said it before, it's the rate of change with liquidity. The nominal liquidity keeps going up because it's a Ponzi scheme. It has to keep going up, right? So it's really that rate of change. So if you see the rate of change come off because you have a build-up of the TGA because there's a government shutdown and because it's all, bill issuance in short term from Treasury, and we've got the Fed just sitting there. Yeah, they're going to end QT in December, but there's no step up of that more direct juice that we've seen in the past in the form of QE. So it's really, but again, look at the size of the collateral piece of that. So the behaviour of the bonds from here on will be, and the US dollar will be incredibly instrumental.
And Joe, just if we focus in on one part of what Paul just said there, talking about the central banks. The heat map this month is really interesting because it's gone back to sort of cover that whole period. So this is from 2020. And you can clearly see COVID as the green on the left there. You can clearly see the efforts that were put in place to sort of extract that liquidity as that big red blob in the middle. And since then, the lackluster that we've talked about is quite visible on the chart as far as I can tell. Like it really is that, there's a bit of green. They have been net liquidity increasing, but it's not that dark, consistent green that you're getting across all economies. That's not what's going on. So time-wise, probably enough time has passed that we can start to see some restriction there. But I think it visually is quite telling.
And I think that a lot of people probably interpret the left part of that chart as normal, that big green blob. Yeah. Expecting that to continue going forward and that to be the signal for more liquidity coming into the system. But as Paul pointed out at the start of the presentation, you've got that inflation overhang, and central banks and policymakers don't want to play that game anymore of benefiting Wall Street versus Main Street. So if they're not going to step in, well, what would actually, let's talk about what would actually cause a large green blob on the map. You'd effectively need some sort of of crisis, particularly probably
Well,
like
that's
in the
what that green blob was. Like it was
yeah,
the mother of all crises,
yeah.
really.
And it's going to be very obvious if something like that happens. It's back up the truck, right? So that's sort of what our argument has been, is that we're potentially in a period where it's as good as it gets unless something goes wrong.
Which is a strange statement to make, but that does actually make sense when you understand how the system is driven. And Paul, I think we can talk about that with the specifics here, because when you dig into the big boys, the main central banks that matter for the total picture, I mean, yes, we saw on that previous chart all central banks and it's sort of lackluster in the middle. You could probably say quite convincingly that the majority of central banks here have been not like this is the chart of them not coming to the party, really.
Yeah. These are some of the red on all that green that we're looking at on the far right of the previous. So whilst, the massive central banks might be still green, the really important ones are largely red. So that the Fed in the last 3 months rate of change is like minus 25% or something will be on that chart. But it's but have a look at China. So China's expanding at a 28% clip, while these other main central banks are all, look at them, they're all negative. So it's that carefully unloading their balance sheet that I spoke about earlier, and the Fed's come out and said in December they stopped QT, but that's not QE. So there's definitely, from a central bank point of view, they're the handbrake at the moment. But we've got to remember central banks are whatever 12% or something of the total index. So, but largely instructive or signalling anyway.
I'll just
Joe,
add one thing on that as well. We're having this discussion on Monday, and if you have a look at the Chinese stock market, for example, it's starting to look like it's going to move. It's been moving higher, and it looks like it's probably going to keep moving higher. And it seems as though, we sort of were in somewhat of agreement that China and US have kind of flipped in terms of what their policy is. So the US is moving more towards Main Street versus Wall Street, just because of the political nature environment at the moment. Whereas China's moved to looking like they're going to try and more financialize the economy and build wealth through assets versus their Main Street. And that's probably what we're seeing in this chart right here.
And that's so interesting when you think that China really has been doing that for a long period of time. You could argue the success of that, and I think we would argue the success of that. In many ways, it did work to bring a lot of people out of poverty very quickly over a long period of time, like over a relatively short period of time. But then
hundreds of millions of people.
Well, and you could certainly argue that worked, but then whether like the consequences of that now, that there's a reason they're changing, right? They're not going, oh, well, we'll just switch over to a different approach because the other one works so well. That's not how it works. They're having lots of issues in their economy that are forcing them to go down the financialization path. So it makes you wonder whether the US in that regard could be making a longer term policy mistake there.
Yeah, absolutely. And really only time will tell. So I was sort of more leaning towards like playing devil's advocate on the liquidity front. If, China, even with all its capital controls, liquidity still leaks out from the edges. So whether that flows out throughout the rest of the world, it probably will to an extent. I just found it interesting that that's what they seem to be doing.
Well, what do you think? And I'll actually ask you about this, Paul. What do you think about this then when we see weekly global liquidity still marching onwards and upwards? I think people do struggle when we say the rate of change is slowing, and they say, but it's the liquidity is increasing, the number is going up. Like you look at that over this year, what did we come from 172 to topping out, let's say 188? Like that's a lot of trillions that have made their way into the economy in increased liquidity over that year. How is Bitcoin back at where it was a year ago with all that extra liquidity in the system? I think this is a vital piece for people to understand.
Yeah, Bitcoin's the canary in the coal mine. When it comes to rate of change, it is the most sensitive asset from a liquidity point of view. And as I said before, and I don't say it dismissively, this is a Ponzi scheme, right? So the whole fiscal dominance that we talk about is the fact, right, that they have to keep issuing more debt to refinance the previous debt and pay the interest, and then continue to run deficits, requiring more debt. So that the liquidity has to keep going up and to the right, otherwise it all implodes. It's really the rate of change. They can't just keep going full tilt because they have inflation to worry about, and so that rate of change has to vary, and that's really the cycle that we're looking at, the index that we're looking at. It's not just nominal, it's the rate of change and the direction. And at the moment, through a number of factors that aren't simply just government shutdowns and TGA bills, there's a number of things going on that have just seen that rate of change come off a bit. So it's and Bitcoin's the most sensitive asset, so it's the one that's come off the most. But it's again, it's the canary in the coal mine. We still have a problem in the coal mine.
And I think we'll argue a bit later, we'll see what your opinions are on this, but that Bitcoin has maybe overcorrected to the slowing in the rate of change. But canary in the coal mine is the perfect analogy to use here, because really that is something that is going missed. That the market is telling you something there, and it's always important to pay attention to that. If we turn to look at the global macro cycle, the controversy really has been over the macro cycle still being in those early phases. And I think where most people are going to push back on our arguments here is they're going to say, but the economy is going to grow. Chris, Joe and Paul, you're not listening. Like, the economy is going to grow because the US administration, look, specifically at the US, is pumping all this money into the economy. Of course it's going to grow. You're showing that on your chart. You've got a leading indicator pointing up there. Why are you telling us that liquidity is going to slow when the economy is growing here? Joe?
Yeah, so liquidity into markets, right? That's the main, probably the point that we're trying to get across. Now, obviously, an expanding economy is a good thing. That's growth in the economy. People are able. There's more employment. People earning more money. Stocks do better with their price earnings and revenues and sales and whatever else. So more people have more money to spend, right? More borrowing in the economy. Our argument is that growth in the economy driven by Treasury QE, which is effectively just putting money in people's pockets, is obviously good, but not as good as putting money directly into financial markets that you see with QE, right? So it's, over time, yes, it will work, and it will drive the economy and markets higher, but it is a very, very slow burn. Now, what I'll add to that as well is, if you put in the $2,000 Trump tariff dividend, or whatever he wants to call it, a lot of people seeing that as very bullish, and that's actually very bullish for the economy. I don't necessarily think that money goes straight into the market, for example. So I think I was making the example the other day that if every Australian family was to receive $3,000, which is the equivalent in Australian dollars, but you're currently living in a cost of living crisis, which a lot of people are, you're probably not pumping it into Bitcoin or the stocks or whatever. You're probably going to go buy something that you need, or you've just done without for a while. So while I see something like a tariff revenue or a dividend or whatever being paid out, great for the economy, not necessarily great for markets long term.
And I just want to clarify something that you said there. When you say good, right, like, we fully understand that putting money into the economy and directly targeting people is good, right? Like, in what most people would consider good here. It's the thing that probably helps the most people. It's the thing that keeps people in their jobs. That's fine. But what we're saying is that doesn't necessarily flow through in the traditional way into raising asset prices. And I mean, I think you could go a step further and say it might be good in the short term, but that system of supporting financial markets that gets so much negativity around it has traditionally flown through into building the rest of the economy, like in a lagged effect, but building the rest of the economy there. This is somewhat untested waters. Yeah,
so like, best case scenario is that some of that money, that $2,000 or whatever, finds its way into the market, but it's a very short-term sugar rush, right? So it's not something that's sustained like QE 2, 3, 4 and whatever other method they employ to keep asset prices afloat. So our argument historically has always been that generally, as liquidity rises, you get asset prices rising, which builds a wealth effect within the economy from the upper echelons of society. More hiring goes on, more spending goes on, because a lot of the spending comes from the top percentage, like the top wealthiest in the economy, whether you like it or not. That's just a fact. So if you I suppose have money going straight directly into the pocket of the lower echelons, it doesn't necessarily find its way into financial assets, because they're going to consume. They're not going to invest it. Versus someone who's wealthy, they would probably just put in assets because they can only consume so much.
Which brings about the elephant in the room, Paul, the inflation. Now, what we would all probably agree on here is that what we're about to see with all of that additional stimulus going directly into the economy is going to have a direct impact on consumer price inflation. Remember, we always make that distinction between asset price inflation and consumer price inflation. But consumer price inflation is probably set to move higher if you are giving more of the base of the population more money, almost by definition.
By definition. So it's, yeah, absolutely. And hence the Fed's dilemma, and hence the split decision on whether they drop rates in December, despite an economy that's clearly not, by virtue of that previous chart, clearly not on fire. So, yeah, and look, and I guess a more recent example is Japan, where the new leadership there has come out with an enormous amount of stimulus for that economy, and you see bond yields rising as the market is saying, well, here comes inflation. So you follow the money when you're injecting it into the real economy like that. You'll actually get CPI inflation rather than the asset inflation that we've seen through, central bank QE as opposed to this Treasury QE.
And we know last time, it's right there on the left of the chart, it was not politically palatable to have inflation rates at what peaked at sort of double digits, but high inflation was universally condemned by the population.
Yep. And it'll be interesting. And look, this is in line with those macro cycles. So we're saying we're barely in mid. When we start to get mid cycles, where you start to see inflation starting to rise before you get late cycle and that sort of stagflationary environment. So it's about now that we should start to see inflation start to tick up, and they're doing all the right things with $2,000 stimmy checks and 50-year mortgages and all this sort of stuff to try and get people to spend a bit more.
It always fascinates me when you look back at this and you go, you sort of look back in history and go, why did they do that at what seems to be the wrong time? And when it's unfolding in real time, you go, it didn't seem like it was the wrong time then to everyone who wanted to receive those stimulus checks. But when you look at a chart like this, you go, well, I can pretty much see what's going to happen. Look, you mentioned bonds, and Joe, I'll ask you about this. We've seen, obviously, debt just continue to rise up into the right. If we zoom in and look at it over a 5-year time period, the bond market has been very stable. I've actually missed a chart here that I'll have to remember to put in with my move index to show that that's been relatively stable. It's been sort of bouncing around a little bit, but just looking at the bond yields themselves, you can kind of tell that everything's running quite smoothly. You've argued in the past that this is to do with quite heavy manipulation of where the issuance is going. Do you see the potential for a tantrum yet, or is it still looking like it can continue? It's how long's a piece of string argument, but
yeah.
How are you seeing it there? Because it still looks remarkably stable against all this background.
Yeah, and there's been a lot of commentary on this. We were talking about this probably 12 months ago, and there was a lot of consensus that yields were going to spike over that 5% level, and I sort of argued they're trying very hard not to do that, as in keep bond yields somewhat suppressed, and that's what's happened over time. Now, clearly they haven't collapsed, and that's a symptom of, well, the Fed doesn't want to cut rates, but at the end of the day, it's not really the Fed that's controlling the market; it's more inflation and growth expectations. So that's sort of where we are at the moment in terms of, we think we're far closer to the end of the cutting cycle than we are to the start of the cutting cycle for anyone that's interested in rate cuts. Not that we necessarily put a lot of weight on that in terms of liquidity. Now, it's not to say that we can't have large rate cuts and bond yields collapse, because if we get what we're talking about, that central bank easing chart, if you get some sort of funding crisis or deflationary event, they're absolutely going to come down. They're probably not going to zero, but unless something happens, we're certainly closer to the bottom, just based on where we think inflation currently is.
Well, and that's what I'm curious about. Like, when we're recording now, the probability is increasing of a December rate cut. I would look at that chart and say the bond market's telling you that if there is one, it's the last one, that's for sure, because it's not priced. As far as I'm looking at that, there's no real room for that at all. How are you viewing it?
Yeah, so I completely agree. And if you look at something that like a little bit more technical, there's a lot of chat and rhetoric around the SOFR rates, which is effectively the overnight financing rate in the repo market. So you pledge collateral and you can borrow money against it. Now, if you look at what some of those rates are actually doing, those rates have spiked, which is the free market rate, overnight free market rate, if you want to call it that, that is spiking 25, 30, 35 basis points above what the Fed funds rate is, which is telling you that they're not in control of that market. So they can cut rates again, but that doesn't necessarily mean you're not going to have these issues in the repo market or continue to have them unless the Fed steps in and does some sort of quantitative easing or liquidity injections, which is exactly what we're discussing, like what drags them in.
And I think that's really important as well, because some of the assumption will be that if the Fed were to cut rates,
that fixes everything. It doesn't fix everything.
Well, because the home loan rates, for example, aren't necessarily going to follow. You're going to have banks who are not following on that because they're going, well, our actual costs is not like it's almost an artificial rate at that point that doesn't mean anything. Like if it can't drag the actual rates down.
Yeah, absolutely. And we've been saying for a while, like you got to remember that we have had the bull run that we've been in terms of asset prices has been on the back of quite high interest rates, right? So, and even sometimes the rates were rising in that period or flat, or we had forward guidance that they were going to rise. Now, there's obviously bumps along the way, but assets have done very well. But for some reason, everyone believes that continuing to cut or these cuts are going to forever continue is going to continue to drive asset prices higher. You can't have both things. Can't necessarily be true in my opinion, which is why we focus on liquidity.
And people haven't been looking at the data. You make a really good point there. People haven't been looking at the data and making those assumptions. They're just using sort of mental logic to go, rate cuts equals price go up, and that's not actually been what's reflected, because as you pointed out, there were periods where rates were rising and we saw significant component of the rally. The other bit, Paul, you've already mentioned this, the dollar. It's a big driver of the liquidity backdrop, and we've seen strength that you alluded to before. If you look at it against this sort of timescale, looking at over the last 5 years, you would argue that the move we've seen up is hardly a big one. It's being pretty muted, relatively speaking. But at the same time, there's no guarantees that it just drops here and that liquidity comes rushing back from the dollar perspective. At least it's a pretty messy chart in some regards.
Yeah, it is, but it's highly sensitive. Like it's the effect of the US dollar on that collateral pool is enormous, and that's by virtue. We say it every week, but that's by virtue of all of the global debt. So $360 odd trillion of global debts. A lot of it's US dollar denominated. So a rising US dollar just adds to the burden of that. It sucks the liquidity out of the market through that balance sheet effect, and so it has an enormous effect, and no one can pick. I've never met anyone who can accurately predict FX markets. So I mentioned Japan before. The yen's weakening. That's hardly helping. So you get the reverse carry trade out of that with their bond prices going up. It's hard to pick from here, but it's the one to watch, because I think it'll be probably in an immediate sense, it'll be more instructive than any other metric we look at in terms of liquidity.
And why do you think it is so hard to pick? Is it because you've got just every country ultimately trying to play their own game, and there's so much. There's so many moving parts. Is that the real reason? I don't know, because I agree with you. It's. I mean, we can see it here. We can see certainly cycles. Like I agree, it can be relatively easy to pick that. Okay, it's bottom, so now it'll go up for a while. But whether it ends up higher or lower over that particular cycle has been very challenging.
Yeah. And for all the talk of, and a lot of us gold bugs are guilty of this, of it, everyone moving into gold over US dollar assets and everything. Well, the facts belie that with the US dollar. So there is still a lot of take up of US dollar, and it's still strong. It's still the basis of so much of the world's trade. And the least dirty shirt sort of argument as well. So there's no immediate indicator that's about to rise or fall. Like it's just a really choppy period at the moment.
I actually think a lot of analysts who are looking at the dollar specifically seem to anticipate that it goes lower at the same time as anticipating a crisis. And the problem I have with that is often in crisis, at least initially, people rush to the dollar. So I think that's adds complication to this. Joe, you want to add something?
Yeah, I was just going to say this is sort of where you need groove in terms of your cycles, because just looking at it by eye, we've had the previous cycle where you've got the 30 and the 4 is a left translated, as in you had a peak on the first part of the cycle.
Very early, yeah.
Very early, whereas the previous 3 are all right translated. So assuming, if you ask Drew, usually if you get a left translated, you move into a right translated cycle, which means that we'll get a cycle high more than halfway through this cycle. So that's probably telling us, if that holds true, that we could probably expect a cycle high maybe around the end of the year, maybe even into early next year. So
yeah, and I think that I would agree with.
If the Fed doesn't cut, maybe
potentially,
or just anything, like whatever causes, I don't know, whatever the narrative is.
I mean, and I agree with that. It's more for me that if this is the up move, it hasn't had a whole lot of momentum behind it when you compare it to some of those other moves where you just get green. Like it's been a very choppy sideways at best. We haven't really moved that far, but I mean,
and the market's pretty much split on December. It's not even like there's any sort of full belief that there's going to be a rate, height or drop or not. Like it's so.
I just think some of those betting markets are just really bullish on there being a cut. So I'm confused. I think someone's got it wrong.
The last couple of days, it's just actually exploded toward the upside of a cut.
Yeah.
So we're up to 85% at the moment. So yeah.
Oh wow. Okay.
Yeah. It's
so yeah,
but the dollar hasn't broken down. The dollar hasn't broken down on the back of that. So what's that tell you?
That's why I think it's a true gamble. I think in that one, it's not there's no certainty there. Look, we'll dig into a little bit of the Bitcoin stuff, but I want to sort of flip through this relatively quickly to get to some of the major points. We know that correlation exists. You can see here projections for global liquidity, as we've been talking about, are sort of pulling back. Well, wealth will fall with that. We've made this point many times about the difference between total inflation and monetary inflation and why it's so important. Paul talked about the sensitivity that we have with Bitcoin specifically to global liquidity. So all that we're good with. Our version of this chart here that we've talked about is showing as well that sort of rate of change slowing, that we've got potentially a little tick up at the end here, but whether it's still not the same as a giant, massive spike higher in the rate of change that often is what we would expect to see associated with big blow-off moves in Bitcoin, for example. But I want to settle on this chart, which is looking at that weekly global liquidity. And obviously, we've had a pullback that would, by all metrics, break that correlation. We have not seen the sort of pullback in global liquidity, at least in nominal global liquidity, necessary to cause this sort of a move, which leads to 2 points. And that's why I want to sort of ask you both about this. Paul, I'll ask you first. Is it the sensitivity argument there that Bitcoin is really trying to front run this? So that's probably the first question I'll direct to you, Paul. The second question, Joe, is like, if that is the case, or depending on how Paul answers that, how do you navigate the snapback when it comes, if it comes, however that works? So, Paul, start with you on that. If you're making the point that Bitcoin is the most sensitive asset to global liquidity, and we're starting to see that slowdown, is that what the price is doing? Is it an overreaction? How are you viewing that?
We've got to remember the amount of leverage in markets at the moment as well. So I think that's a big part of what's driven this down further than what you would anticipate at this time part of the market. But to my earlier point, a 30% drop at this period in the cycle is not, there's plenty of precedent. And 35 is a bit more. So I think it's overdone it for sure. I'm not personally discounting the effect of the 100 in this equation either, that there was just some psychological selling at 100 with some OGs that have had it forever, and that's their exit time. But no, it definitely feels overextended. But there's just so much uncertainty, I think, at the moment with new concepts for people to get around. Joey, in terms of the US financial plumbing, that all of a sudden everyone's talking acronyms of SRF and all these different acronyms that no one even knew about before, because all of a sudden that's where all the focus is, and it's a different mechanism at the moment with the moving of the QE to Treasury. So I think it's an overreaction until things settle down and people see that it's not broken, that the Fed can step in at any time into the SRF and save the day, and not even call it QE. But I just feel there's a lot, because a lot of varying debate on Twitter and whatnot at the moment. So I think there's a bit of overreaction at the moment.
And it's always dangerous when we get a whole lot of new armchair experts on four-letter acronyms that they didn't know anything about a week before. Joe, how do you navigate that then?
Yeah, I just wanted to touch on Paul's point about like that OG selling, and clearly there's been a lot of OG selling, and you combine that with a slowdown in global liquidity. Add on top of that, you look at what happened. I know it's a few weeks ago now. That large sell-off we had on that Friday night or Saturday morning, depending where you are, on October 10th. There is a bit of speculation that there were a number of market makers who got carried out on that, and there was some forced selling in the weeks following that as well, which, I'm not saying that's absolutely what's happened, but you combine that OG selling potential market makers who got carried out, who are effectively the bodies floating to the surface after that event, because the liquidity algorithms all broke down, the market making algorithms all broke down. You look at other markets and you look how much Bitcoin has just didn't even really crash over the last couple of weeks. It was just steady selling. Like, you get a bit of a bounce, then you'd have these sellers stepping in as well. So I think that it is absolutely overdone, as Paul said. This is why we don't sell the bottom as well, because it is overdone. Like, there's a lot of fear in the market, obviously, but if we were looking to the future and where we think we're going to put the sell signal, we still need a bit of time for this to actually play out, and we do believe that bounce is coming because it is overdone based on market positioning.
And we can sort of back that up looking at some of that cycle work, which again we don't use for specifics really of anything, but to just manage expectations. It's pretty much spot on where we would have expected the cycle low to be from a timing perspective. So, there's nothing unusual about this cycle, and it feels like, when you look at some of the sentiment scores that were floating around, that was worse than the bottom of the FTX crisis. It feels like people feel there's never going to be another green candle. We're never going to see any sort of move. I mean, there's a real danger in that, isn't there, Paul? You can't get caught up in
the fear and greed index hit 5 or something. Like it was
insane,
insanely low, right? So that we've been sharing amongst ourselves the various headlines on various mainstream media outlets of, as soon as you start to see, it's dead, that's back up the truck. But so no, look, it definitely feels like that, and we've got to draw the distinction too. So we talk about with the fund that we shield the volatility from those big drawdowns. We're at pains to say we're talking about the big drawdowns at the end of the cycle. So we're still saying we do not think this is the end of the cycle. If you plot this against the various previous cycles with the global liquidity index, there's always or has always been a blow off top type rally after you see that topping of the GLI. So that would have to be different this time, and we don't think it is.
And it's certainly not when you look at where we were 12 months ago, fundamentally so much has improved for the asset that there's many fundamental arguments you can make beyond the technical that would support the idea that you get at least one bounce higher out of that. I do want to quickly cover gold and silver because it is an important topic, obviously part of what we're doing, and under any other circumstances we would have been giving so much more attention to this over the last couple of months because it's just been massive new sort of highs and then even the pullback has been quite subdued. Really, it's look, they're looking very strong. We're just so caught up in Bitcoin because it's like it feels it needs to steal the show. But Paul, what are we seeing here? Is gold consolidating? Has it topped out? What's your view? I mean, obviously they're loaded questions, but what's your view based on really some quite impressive holding up?
One might say rhetorical questions, Chris, but it's look at that last. Nothing goes up to that extent without a pullback, and we're having the pullback that we expected. To be honest, it's probably surprised us the lack of depth that it's shown. So it seems to be holding up and even rebounding to some extent. So I think that's just natural markets. Things get overbought and oversold, and then but this time I don't think we got oversold. I think there's so much support. Everything we've just talked about, right? The whole debasement trade which was on tips of everyone's tongue, half of them understanding it, but it hasn't changed. Like this is the same game in town, and China is the level of that stimulus that they're putting out there. They're very clearly, deliberately backing that up with gold. So I'm not saying gold-backed currency, but they've made a very clear decision to increase their gold holdings substantially and far more than what they're publicly revealing. But there's great evidence to show that it's multiples time what they've been disclosing because of that same thing. So that there's a sovereign, the second biggest economy in the world that's backing up their debasement with gold. So why wouldn't mums and dads do that and institutions do that? And that's what's playing out, I think.
And I just had the silver chart up there, but looking at the gold-silver ratio as well, I mean, obviously silver's been doing exceptionally well and outperforming gold, which has been quite challenging for us from a perspective of trying to fit that in where it would normally fit in the cycles, because normally you would expect that a bit later. Do you think it's a little bit different at the moment? It really is a genuine supply story?
Yeah, because again, when you get volatility, normally silver would be more volatile than gold, right? So it tends to overshoot and undershoot, but it hasn't, and I think that's just because of exactly what you've again just rhetorically said, is that it's structural. Like the amount of silver demand just through industry and growing awareness from an investment point of view compared to supply has just given it a base that's less volatile.
If we sort of pull all that together and look at our framework, I think that it really is. We're in the right assets, that's for sure, of how they fit. But the silver one is just fascinating to me because the supply stuff. I mean, we've seen it. You'll be able to speak to this more than me, Paul, but we've seen this with our physical suppliers, with our customers. The conversations that we're having, it's real. It's not a hypothetical.
Nah, not at all. The premiums jump so quickly because of the thinness of that supply, and so no, it's structurally it's feeling great. And just think of just the things that are on the front pages of papers, like the whole energy and build out of AI. Like the amount of silver that's required in that is just phenomenal. So no, it's not a flash in the pan story. This is structural industrial demand, and then again the growing awareness of people of precious metals as an investment inevitably leads them to silver as well when they didn't even know about it. They just focused on gold.
Yeah, and that's the journey I took back in the day. It's one that I think is very common. look, as we come to this sort of end here, we do like to provide this trading plan that we've provided the whole time. We're following along, trying to buy low, sell high. That's the dream. You can see our buy signal there, the 10th of January 2023, and as I said earlier, we've ignored sort of the technical sells into this last one, which we're expecting to create a sell signal. I'll talk about that in a second, to my expectations sort of going forward. But even what's fascinating about this is when you actually look at the stats and go over that period of time, 1,050 days, 144% annualized, 414% over that period of time. Like even with that massive pullback, still no asset like it. And what it will be when we put that sell signal in, who knows? But even if we were to put it in today, it's still very, very hard to beat 144% annualized return. So I think that's a great way to end the year, really, even coming from those lows. And as we said, we don't really expect that to be where it ends. Look, it has been a massive year. There's a big year ahead, I suspect. We are expecting it to be probably even more challenging than this year was. So I will go do the round the grounds and sort of see where everyone's sitting in their expectations for where we'll be over the next 2 months, because we won't be doing one of these in December. We'll be back again late January. My perspective is sort of what we've alluded to throughout and talked directly to. I'm expecting that we probably, balance of probabilities, will see us putting in that sell signal sometime over the next 2 to 3 months. Hard to say exactly when, but it won't be here. It'll be on a bounce. And I can see the liquidity conditions not necessarily improving. However, my view on this is that the crash that follows, the bear market, however you want to word it, will probably be quite short-lived. I am expecting a huge response where genuine QE comes back into the system, and that could be after a relatively short period of time. We might only have a 6-month down period, or possibly even shorter, who knows. So I think next year is going to be absolutely fascinating one to watch, where we might see the buy signal, the sell signal, and another buy signal potentially in that one period of time. But we'll have to see how specifically that unfolds. But I think volatility will be the name of the game for next year. That's my view. Joe, I'll hand over to you to get your sort of wrap up and take over the next few months.
Yeah, and like you pointed out, we were looking to put that sell signal in, and I think we also got to remember that Bitcoin's actually down for the year, right? So it's actually lower than it was a year ago. So and that's that's where that very poor sentiment comes from, because we've had a bear market in price, but we've also had a significant bear market in time, and that's really shaking a lot of people out. And I think, generally speaking, going forward, regardless of where you think it's going to go where Bitcoin's going to go over the next couple of months, you do make your money in these sort of situations, right? Particularly when we've oversold like we are, and we're expecting some sort of a bounce before we put the next sell in. So if you're over a long enough time frame, like this is situations like this where you're 35% down is literally where you make your money. And I'll be the first one to put my hand up and say I was expecting a much stronger Q4, and we haven't had that. The Q4's not over, so anything can happen. But I'm looking forward to seeing how it plays out the next 6 weeks, and 6 to 8 weeks, and when we put that sell signal in, we'll be letting everyone know. That's for sure.
And it could be from a higher high, like it could be from all-time highs too. I'm not writing that off. Q4 is seasonally is the time when these things happen. Paul,
I've talked about the Santa rally, and that's certainly not off. Yeah, I mean that 60-day cycle chart we're right there. So this absolutely could turn from here. What we've been at pains to say today is that there's not the fuel for that evident. So it would be I think just a bounce off just poor sentiment, an oversold position. But to your point, I think there's a number of things that are happening over the coming even 6 months that that people are hanging their hat on to support this rally, I think, prematurely. But there's the change to the SLR could be very supportive for liquidity, and there's the big talked of drawdown of the TGA that's been built up over the shutdown, without people understanding the amount that they have to have there now because of the sheer amount of short-term bill issuance that needs to be refinanced to the tune of
Fed chair.
500 billion every week. New Fed chair in March, who may or may not be, best sent the Treasury Secretary is at lengths to say he doesn't want QE. So a new Fed chair doesn't necessarily mean that they just come and step up with QE. So there's a bunch of unknowns, right? But there's a bunch of quite supportive things that could come off as well. So so we may well see us selling this bounce from here, or we may actually see the juice come into the market that takes us into a longer cycle. So it's and then if Drew was sitting here, he'd be talking about the confluence of a whole bunch of cycles that land around 2026 that throw that in there as well. So 2026 is going to be a very interesting year. But I'm very confident of our framework and the discipline with which we go about reading all of these indicators and making the right call. But so it's watch the space. It's going to be a strap in.
Yeah, and I think the summary of that for all of us is that it's going to be a year where it's particularly important to have this sort of analysis that we're doing consistently. I really like that point you're making there, Paul, about it's the discipline and keeping coming back to that. I think that's how you navigate these times. And we knew it was going to get harder before it gets easier, and then we're in that harder bit. So that's why we're here. Look, thank you both for your time. Thank you both for your time this year, coming back and doing these. I know people really get a lot of value out of this consistency of the approach. So we really value that. Thank you, Joe. Thank you, Paul.
Thanks, Chris. Can I just say on behalf of all the Ainslie group to our viewers, just wish everyone a great festive season. Hopefully kick up, enjoy a Santa rally, and that's all. Look forward to the next year.
Absolutely.
Thanks, Paul.
Absolutely. Look, thank you everyone for joining us. Remember, we always love that feedback. We will be back in January, probably towards the end of January next year, to see where we were right, see where we were wrong, see what's happened since. Hopefully, we were all very happy with that big Santa Claus rally. The Christmas tree's right there. It's got the Bitcoin all over it. So fingers crossed. Look, wishing everyone a Merry Christmas. As Paul said, we really appreciate your support. We'll see you again next year. Thanks. We'll chat again soon.